Let us walk through the most common hurdle buyers are running into in 2025 and how to avoid them yourself. First is your debt ratio. We don't use your net income. We use your gross income on everything that's claimable, that we can follow, that we can prove. Anything that you get like Social Security, pension, W 2, 1040s, 1099s, any income that you claim we can use. If you get anything cash, we can't use that income unless you claim it on a Schedule C. So any income that you want to use must be verified as valid income. So your debt to income ratio, we take the gross income on a W-2 pay stub wage earner. We take the gross and divide that by whatever the debt that you have. It's not cell phone. It's not your gas bill. It is whatever's reported on your credit report and or what comes out of your pay stub, such as maybe alimony, a judgment, or child support. So we use that on the debt to income ratio. We use gross income on what your mortgage debt's going to be. So you got a front end ratio, which is just the housing expense when it comes to the mortgage payment, the principal and interest payment, taxes, insurance, maybe some flood insurance, if you earthquake insurance, monthly HOA. That is your front end debt ratio. So we take the gross, divide that, and we can't go above. Some will allow us to go up to 47% front end. Then you got your back end debt to income ratio, which is your gross income, your mortgage plus all your other debt that reports in your credit report and your pay stubs, like I said, any kind of wage garnishment. We add those up and then you got your back end debt ratio. So you got your mortgage plus your back end debt ratio of all your other debt. That cannot exceed in some programs at 57%, which is kind of high on some of these programs. But they will vary from program to program on how high we can go on your debt to income ratio. So the key is keep your debts low. That's the key. Don't go out and start buying a bunch of stuff, even though you may need it. Let's get you into the home, then go buy whatever that you need versus a want. Then credit scores. I just did a video about credit scores. Higher the credit, the better. There's different programs that will go down to a 580 or 620 minimum credit score, but higher the better. And how you do your credit score is pay your debt on time. Don't be overextended. Don't open a lot of credit in a short period of time, especially on the holidays. You want to go Christmas shopping, open up a new credit card, get $20 cash back, $100 cash back. Don't do that because all that's doing is creating inquiries on your credit report. Also, if you can raise your credit limit, do that because if you're always running to the credit limit area, but be very cautious with that. And you need to be mindful on raising that limit. Don't raise your debt. But if you have a $2,000 limit on your credit card and you're running $1,500 and they'll raise it to $5,000, now that debt load just shrunk because you have a $5,000 limit against a $1,500 debt. But disclaimer, that doesn't mean you can go spend more money. So keep those debts low compared to the limit on that card. Keep the cards that you've had for a very long time, keep those open. Don't go out and start canceling cards. Oh, I haven't used this card in 6, 7 years. Don't make a difference. Keep it open because you have a 6-year history on that credit card. When you start canceling old revolving credit cards that are opened, that now just canceled that 6-year, 10 years, 20 years of good credit history. Now, if you opened up a credit card 8 months ago and you want to cancel it because you don't have a longevity on that. Pay your bills on time and don't overextend. That's the key. Insufficient funds. You need money to purchase a home. You need money up front to do your home inspection appraisal. You need money for the down payment, and you need money from closing costs. And we can talk different avenues on where we can find you the down payment money when it comes to down payment assistance, a gift from family, and also on closing costs, you can get that from the seller, you can get that from the lender. So there's some creative ways to get you funds to purchase a home. But if you have $2,000, it's going to be very tough to purchase a home. So save, save, save. You don't need to go out and go to the movies every weekend. You don't need that new purse. You don't need those new shoes. You don't need to go on that vacation. Save money. What's more important? Get into the home and then go through those things afterwards. If the home is your goal, then let's get you on the track of owning a home, which is credit, lower the debt ratio, save some money. And if you have to make food at home and take to lunch, that's what you need to do. Things are getting expensive anyways. Employment. As long as you have employment to your history of it and you have reportable income, we can use that. Changing jobs multiple times is not a key to home ownership. So Let's get you into that home. But if you're changing jobs because it's better in your financial situation, by all means, getting you closer to home, spending less money on gas, wear and tear on the car, by all means, do that. Speak to a licensed mortgage professional. Let's get you on a game plan, a routine, something that's going to get you into a home, a budget, something that you're going to follow, a blueprint on your path to home ownership. And that way is debt ratio, save money, credit. We can talk about all that in depth to get you on the path towards home ownership. So those are the keys going forward that you want to ask. How can I own a home? These are the 4 items that we can discuss in length to get you onto that blueprint, onto that path of you owning a home. My name is Nathan Ruff. I'd love to talk to you further about that. All my contact information is below. Happy house hunting, but talk to me. Let's get you on that blueprint towards home ownership.